Affirm just dropped an explosive fourth quarter earnings report. And honestly, they didn't just beat expectations, they might have just rewritten the entire story for the buy now, pay later sector. So let's break down exactly what went down.
The market's reaction was pretty much instant. The stock just shot up, surging nearly 17% in after-hours trading. So what was all the excitement about? Well, it wasn't just about record performance. This was a major strategic breakthrough that investors have been waiting a long time for.
I mean, just look at these headline numbers. It was a clean sweep. GAAP EPS came in at 20 cents, which almost doubled the estimate. Revenue crushed it. And gross merchandise volume, that's, the total value of everything sold on their platform, it hit a record $10.4 billion. That's a staggering 43% growth year over year.
But this is the headline. For the first time ever as a public company, Affirm is now profitable on an operating basis. This is the milestone, the big one, that investors have been waiting for. It finally answers that huge, lingering question. Can the BNPL model actually make money at scale? And the answer, it seems, is yes.
So the next question is, how did they pull it off? Well, this incredible performance was really ignited by a powerful two-track growth engine that's just firing on all cylinders right now.
Think of it like a 1-2 punch. On one side, you have these merchant-funded 0% APR plans, and they are like a magnet for new, high-quality customers. Then, on the other side, you have the Affirm card, which drives repeat business, gets people using it more often, and expands their reach into everyday offline spending. One brings them in, the other keeps them active.
And the scale here is it's staggering. The volume on these 0% APR loans grew over 90% year over year. And this isn't some loss leader either. These are profitable loans because the merchants are funding them. They see it as a much more efficient way to spend their marketing dollars right at the point of sale.
At the very same time, the Affirm card is on absolute fire. Card volume soared 132%, and it contributed over $67 million in revenue this quarter alone. In the words of CEO Max Levchin on the call, the card is kicking ass and taking names.
So you have to wonder, right? Why hasn't everyone just copied this 0% APR strategy? When an analyst asked that on the call, Levchin's answer was pretty blunt. Because underwriting is hard, and we're good at it, and others aren't. That confidence right there in their own risk modeling, that's what they see as their key competitive advantage.
But of course, it wasn't all just a victory lap. The call definitely had its challenges. Analysts were quick to zero in on potential headwinds, especially the end of a really major partnership.
Yeah, management had to directly address the elephant in the room, the end of their direct integration with Walmart, but they laid out a really clear de-risking strategy. They basically said they're confident that the growth from their own direct-to-consumer channels, the Affirm card, and their deep platform partnerships with giants like Amazon and Shopify will more than make up for it.
And on the topic of consumer health, they were adamant. Credit, they said, is job number one. They reported that their credit metrics are holding stable, and delinquencies actually improved from last quarter. Their secret? They underwrite every single transaction in real time. And get this, 95% of their volume comes from repeat users, which gives them this incredibly rich data set to manage risk better than anyone.
All right, so that was this quarter. What about looking ahead? Well, when it came to guidance for fiscal 2026, management didn't just meet expectations. They projected a continued acceleration that blew past what Wall Street was expecting.
So their outlook for the next quarter was strong, sure, but the real headline was the full-year forecast. Management is projecting a GMV of at least $46 billion. By setting that as the floor, they're signaling some serious confidence in their momentum.
Now, what's really crucial here is what they said about their unit economics. Management expects their take rate, basically the profit they make on each transaction, to stay high. And this is key because it suggests they can stay really profitable even while those super popular but lower margin 0% APR plans become a bigger and bigger piece of the pie.
And all this profitability gives them a solid foundation to expand. Future growth isn't just about doing more of the same old thing. We're talking about new frontiers. They're already testing internationally. In the UK, they're pushing into the massive offline market with partners like Stripe, and they're using an AI tool that's already lifting merchant sales by an average of 5%.
Okay, so let's put it all together. What's our take on the stock as we head into the next quarter? So here at Talk Tickers, we are rating the stock outperform. All eyes are going to be on their execution through the holidays, which is obviously a crucial season. And look, the stock has had a massive run, no doubt about it, but we believe the company has multiple ways to beat expectations. They've proven the model is profitable at scale, and they've laid out these clear, powerful paths for future growth.
So, the real takeaway here is that Affirm has fundamentally answered the single biggest question that's been hanging over this entire sector for years. The debate is no longer about if this model can be profitable. The new question for investors to really chew on is, how sustainable is this profitable scale and just how much bigger can it get?
And, as always, just a reminder that this is for informational purposes only and is not financial advice.